You ever wonder how professional traders make sense of all the chaos in the stock market? Like, how do they actually decide what to buy or sell every single day? Is it just a gut feeling, or is there a real system behind it all? Well, today, we're going to dig into that.
So, what you're looking at right here, this isn't some generic textbook theory. Nope. This is a page from a real trader's handwritten playbook. And we're about to pull this strategy apart page by page to see the kind of disciplined process that really separates the pros from everyone else. So, yeah, let's jump right in. All right, so here's how we're going to break it down. Following their logic step by step. We'll start big, reading the entire market. Then we'll funnel down to find the hot sectors. After that, we'll walk through the actual stock selection process, and we'll wrap it all up with the golden rules, the stuff that you just don't break.
Okay, so step one. First things first, before this trader even thinks about a single stock, their entire day, their whole strategy is dictated by one thing, the direction of the overall market. Seriously, this is the foundation for everything else that follows. The whole strategy kicks off with a really simple but powerful rule. Their compass? It's India's Nifty 50 index. If the Nifty 50 is green, meaning it's trending up, then the plan is to look for bullish stocks that are also going up. Simple enough, right? But, and this is a huge but, there's a crucial exception. What if the Nifty is green, but that very first 5-minute candle of the day is red? Well, the playbook says to flip the script completely. You start looking for bearish stocks. It's a sign that the early morning hype might be a trap, and the real momentum is actually heading down.
And the notebook is just as clear about what not to do. It lays out some big warning signs. For example, if that first 5-minute candle is a doji, one of those where it opens and closes at pretty much the same price, that means total indecision, so you just stay away. What about a giant green or red candle right at the open? Nope, too volatile, too unpredictable. And here's the part I think is brilliant. The playbook tells you exactly where to put your stop loss, your safety net. It's set at 50% of that first 5-minute candle's high. See? The risk management is baked right into the system before you even make a trade. All right, so you've got the market's direction figured out. Now what? Well, you don't just start picking random stocks. The next step is to zoom in and find which sectors have the most momentum. I love this analogy. Think of the market as a giant river. This step is all about finding the strongest, fastest moving currents within that river. And this quote pulls straight from the notebook, just nails the logic. It's all about stacking the odds. It's not enough for the market to be bullish today. They want to see that the sector was also strong yesterday. It's that alignment of both market and sector momentum that they believe creates the best opportunities. And this is where the homework comes in, right? The notebook is filled with these pre-made watch lists for key sectors. You've got IT, auto, pharma, and so on. These aren't just random stocks. These are the traders' go-to names, the ones they know inside and out. Having this all prepared means there's no scrimbling around when the market opens. It's just about watching for the signal and then executing the plan. And you find these other really specific rules scattered throughout the playbook, like this one. If the Nifty 50 is down, then the metal sector must be down. It's like a hard-coded rule for them. If the main index is falling, they just assume the metal stocks are weak. It's just another one of those simple filters to cut through the noise and stay focused.
Okay, so let's recap. We've got the overall market direction. We've pinpointed the strongest sectors moving with it. Now it's time for the final filter. This is the nitty-gritty. The 4-step process for taking a big list of stocks and narrowing it down to the final 1 or 2 you might actually trade. So this is how it all comes together. Step 1, you start with a broad list, maybe 20 to 30 of your favorite stocks that match the Nifty's direction. Step 2, you immediately filter that list down by only looking at stocks in that day's strong sector. Step 3, you use a heat map, like from the NSE or OPSTRA site, just as a final confirmation. And then, only then do you get to step 4, which is all about your entry point. Sell at resistance, but buy at support. In other words, you don't chase a stock that's running up. You wait for it to pull back.
And hey, for anyone who's not familiar with those terms, it's actually a really simple idea. Think of support as a price floor that a stock has trouble falling through, and resistance is like a price ceiling it has trouble breaking above. This trader isn't trying to buy when a stock smashes through the ceiling. Nope, they're waiting for it to come down and bounce off the floor. It's a much more patient, conservative way to enter a trade.
Look, you can have the best system in the world, but it's worthless without discipline. And that brings us to maybe the most important part of this whole playbook, the golden rules.
And let's be clear, these are not suggestions. These are the hard nevers and always. They're designed to protect the trader from making emotional mistakes.
This first one is huge, and it's written over and over again in the notes. Never go with breakout stocks. Now, think about that. So many trading strategies are all about buying breakouts, but this trader, they forbid it. And why? Well, it's most likely to avoid getting caught in a false breakout or a bull trap where the price spikes up and then comes crashing right back down. It's all about avoiding that risk. And in that same spirit, the rules say to avoid stocks that gap way up or way down at the open. A big gap usually means a lot of hype and emotion, which makes the stock super unpredictable. This system is clearly designed to prefer stable, calmer price movements.
So if you're not chasing breakouts and you're avoiding gaps, what are you supposed to do? The answer is simple. You wait. The playbook is crystal clear. Always wait for a retracement. That's just a fancy word for a small pullback in the price. So instead of chasing the stock higher, you patiently let it come back to you, back to a level of support. Then you look for your entry signal. The entire strategy, you can see, is built on patience.
Now this one feels personal. You can almost feel the painful trade that led to it. It says, never do scalping in banking stocks. Now, scalping is that super fast in and out trading style, trying to grab tiny profits in just seconds or minutes. This rule pretty much says that banking stocks are just too wild, too choppy to even try that kind of thing. It's a very specific piece of hard-won experience right there on the page. So when you put it all together, what do we see? This isn't the playbook of a gambler hoping to get lucky. It's the playbook of a strategist. It's a system, a funnel, designed to filter out the noise, to sidestep crazy volatility, and to only act when the odds are stacked in their favor. And that really leaves us with one big question, doesn't it? In a market that's just drowning in data and noise, maybe a simple, strict, disciplined process like this is the most powerful tool a trader can actually have.